Welcome to Module 2. Before we ever crunch numbers on a property, we need to answer one big question. Where should we be investing? So you can buy a great property, but if you do it in the wrong city, wrong market, it can and it will bleed you dry. The right market will lift even an average deal into a long-term winner. So in this lesson, we're going to cover the 3 key indicators that tell you if a market is healthy and likely to keep growing. And those 3 things are population growth, employment growth, and income growth. There are many more, but these are the main ones that I like to focus on. And I'll show you how these 3 ingredients directly fuel sustainable real estate price growth. So population growth is the engine of real estate demand. Every housing market starts with people. When more people move to an area than they then leave, demand for the housing goes up, right? It's as simple as that. More renters means more higher rents, more buyers, higher prices. And here's the nuance. We don't need explosive growth. We want steady, sustainable growth. Boom and bust markets are the ones that can spike, and all the hype and one industry and all that kind of stuff. That's all dangerous, and that requires market timing, which is not what I'm all about. That's not what long-term cash flow investing is really all about, right? We don't really want to have to sell these assets long-term. We want to refinance them and just hold them and hold profitable little mini businesses, right? So when the jobs dry up and the population slows, prices can collapse just as fast as they went up, right? What we're looking for is consistent population growth in an area, usually 1 to 3% year over year for a long period. That tells us that a city is stable, attractive, and growing in a healthy way. So you can find this kind of data in places like Statistics Canada for Canada, or the US Census Board in the United States. Or today, you could even really just look at the population growth by city using ChatGPT and just get the exact amount, and it will find these stats for you. And ultimately, you want to get the growth rate of the population in a city for multiple years, and then you can start getting the average growth rate. So don't skip this step. You're going to want to get that 5-year growth rate. I like to get the 3-year, the 5-year, and the 7-year growth rate for the population. The second thing we're going to look at that we also want the 3, 5, and 7-year growth rate is job growth, which kind of drives population growth, right? It brings people, which then brings higher housing demand. A market with rising employment has stable rent collections, less vacancy risk, and really if companies are hiring, employees are going to be moving in, spending money, supporting the local economy. And you want to be able to see diversified industries, not just one big employer or one sector like oil, tech, or tourism. The more varied the job base, the safer the market is going to be. So you want to look for cities with consistent decline in unemployment rates over several years, new business investment, or infrastructure expansions. That's a really big one. You can even just type into ChatGPT even, what are the major infrastructure expansions in the local regions, or which city has the biggest infrastructure expansions. And you're looking for a balanced mix, right? Service, tech, education, manufacturing, healthcare, energy. All in all though, major transportation expansions or mega development projects, those are a great indicator. I think I like major transportation developments is one of my favorite ones to look for. So even with population and jobs, if people's wages aren't rising, rents and prices eventually do hit a ceiling. When incomes rise steadily, tenants can afford gradual rent increases and buyers can qualify for higher mortgages. So both of these push values up sustainably. So you're looking for median household income growth as well. That's another thing we're looking for. 2 to 3% per year is great. That's healthy inflation, beating growth. So now let's talk about the price growth. When population, jobs, and income are all trending upwards, property prices are naturally going to be going up. That's how you get that as sustainable appreciation, the kind built on real demand, right? Real purchasing power, not speculation. So if prices are rising, but none of those fundamentals are improving, it's kind of a red flag, right? It doesn't make a lot of sense, right? The story doesn't check out, so to speak. It means that the market's driven by emotions or short-term supply, perhaps, right? So you got to remember, right? Population growth drives job growth. Job growth drives income. Income drives sustainable price growth. That's the economic heartbeat of every long-term real estate market. So how you put all this together is with a market checklist. When you're researching a city, use this quick checklist. Population growth. You want to have at least a 2% annual growth rate for 5 years in a row. Employment growth. Multiple strong industries, new projects, low unemployment. Income growth. Medium income rising faster than inflation, right? So these are the two things you're kind of comparing. Price growth. You're looking for a steady real estate price growth of, I'd say, between 2 and 6%. I think really realistically at 4% is what I kind of, if it's not growing at more than 4%, then I usually don't think it's the best market, because you got to remember with real estate, there's a leverage piece. I'll give you a basic overview if you don't already know this, but if you put 50% down on a property, or let's just say even 35% down on a property, 1/3 of the purchase price down on a property, and the property goes up 5%, you have leveraged 1 to 3. So if the property is worth $100,000 and it goes up 5%, which is $5,000, that's $5,000 of return on investment, but you've only put down $33,000 on that $100,000 purchase. So $5,000 divided by the $33,000 down payment, it leverages your return upwards. So that 5% actually becomes 15%, 3 times the return on investment. And that's the power of leverage in real estate. So when we're looking at these market growth rates, if I can find a 4% return, if I'm putting 25% down on my property, that's 4% times 4, because I have leveraged 1 to 4, if that makes sense. So that's a 16% return on investment on appreciation, not counting cash flow, not counting my mortgage being paid off, right? And that's why we're doing this exact part of the course first, right? We got to pick the right market. If a city is checked for all 4 of these boxes, right? The incomes are going up, the population's going up, the real estate prices are going up. All these things are going up, and we can understand the story of why they're going up. Then we can count on that appreciation really kind of taking place, and we can really have a good idea of what kind of return we're going to get on appreciation over the long term, not counting cash flow, not counting debt repayment. So that is why we're doing this. If 1 or 2 of these indicators are weak, dig deeper to understand why. It's important that you understand why something is growing. Why is this city growing? Why are people moving here? Is it just an oil boom, right? And people are just moving in there, and then as soon as that's gone, they just leave? That's not what we want. I'm not really interested in timing the market in that way. I've tried. It doesn't work. And they're not liquid assets that I can easily buy and sell. So I want you to build a simple 1-page summary for each of these. I've actually included a template. I might as well cover it right now, but you can see here, I have a real estate analyzer and budget template. So tab A, the very first thing, the tab A here is where I can put in each of these indicators. You can kind of see here, go back as many years as you want. I recommend 7 years, and just try and find like the population growth per year, and that'll give you a percentage. You can figure out what percentage it's been growing per year. Same with job growth, same with rental real estate price growth, and you could even do income growth as well. But if you start to see that like there's a growing trend, or that it's increasing, the population growth is increasing in its rate, or the job growth is increasing in its rate, I'm going to start to be able to get an estimate. And this is where I put in here an estimate on my growth, 3 and 3.5%, or 4%, depending on what it is, right? So you're going to do that. And your homework is to hunt for a market it could be close to you. It doesn't have to be, right? I've bought properties all over the place. But this is kind of a guide to get you looking into these key numbers. The best investors, they don't just chase hot markets. Really, they study the fundamentals and they position themselves really well and really early. So in the next module, we're going to actually get into the step-by-step on how to analyze a property once you've chosen the right city. I think in the first video, I said I was going to do it in this video, but I wanted to cover this first, right? So in the next video, I'm going to show you the cash flow zone rule. It's a really quick way where you can filter out a deal in seconds. And yeah, other than that, I'll see you in the next module, module 3.